All right, welcome to Animal Spirits with Michael and Ben. We're going to start out talking about real estate. There was an article in the Journal last week showing that U.S. homeowners cashed out $152 billion in home equity last year, a 42% increase from 2019 and the most since 2007. Obviously, there are a few things at play. One is people needed cash, right? Two is they needed cash to survive the pandemic. Two is ultra low interest rates. Three is rising home values. And maybe number four is people staying put and doing a lot of home renovations.
It is surprising. They show this by year going to 2000. It was double this in like '06, '05, '07. And so even though this is increasing, it was way higher back then. And
It's a crazy chart. Wow.
it would shock me if this didn't continue to rise for a number of reasons. One is, how often do you hear these anecdotal stories of people trying to buy a home? We talked about it last week for some listeners, but I just heard again this weekend, hey, my coworker's son is trying to buy a house, and every house he tries to put a down payment on, it ends up going for $50,000 over asking. You're hearing all these stories. So eventually people are going to say, all right, you know what? Screw this. I'm not going to try to buy a new home if this is going to be the market. I'm just going to renovate my current home and make it better. And rates being so low and the fact that everyone has equity in their home now, if you bought a home in the last, I don't know, anytime within the last year or longer, you've got some decent equity built up already from the leverage, right? So why aren't people going to start taking that out at low rates and take some equity out of their home and just make it better or use that money for something else? So it would shock me if this number didn't go higher.
Yeah, I'm with you. I'm curious to see what happens in the spring when people that were planning to move but didn't want to move because of the pandemic put their house on the market. I suspect that there will be a lot of supply, but will probably be gobbled up by demand because there's so many people my age that are still first-time home buyers that probably missed their window last year.
Yes, there should be more people who just said, I'm not going to have people walk through my house during a pandemic. I'm not going to sell. So you could definitely see it like this summer. I'm sure there's going to be a lot more, hopefully, a lot more supply that comes on because it is so low right now. The other good thing about this, so the Federal Reserve, the New York Fed, breaks it out by, they break out these mortgage originations by credit score, and these originations contain the refis. And the vast majority of them are for credit scores 760 plus. Whereas in the past, especially in that 2005 area, a lot of these refis and mortgages were going to much lower credit scores. So these are more high quality borrowers now. So this is not like a bunch of subprime borrowers taking money out that are going to default someday.
So there's a few more data points that I want to highlight. Before the housing market crashed, this is the article, before the housing market crashed that followed the crisis, almost 90% of borrowers who refinanced chose to extract cash. Last year, about 1/3 of refinancers chose the cash out option. So what happens is you take cash out of your house and you just tack it onto the end of your mortgage, right?
Yeah, so you just take out a little bit of a bigger mortgage.
So then they said there could be other pitfalls to cash out refis. When you do refinance it to a new 30-year mortgage, you essentially reset the clock on your payments. So over time, that obviously could add years to the life of your loan, potentially. And you could end up paying tens of thousands of dollars in additional interest, not to mention closing costs.
Right, if you've been paying your house off for 5 years, you would technically have 25 years left if you have a 30-year fixed mortgage. But if you refinance after that 5 years, now you have another 30. So you have to think about that one of the things that I did with my first house is every time I refinanced like 4 times. Every time I refinanced, I kept paying the same exact amount. And honestly, by the end of it, I think I went from 6 to 3 or whatever. I was almost making a double payment by the time I was done refinancing. Obviously, the rates have probably hit their lower bound and are now moving up now, but that's the idea. I also wanted to talk about the fact that last week we mentioned why real estate is a good hedge against inflation. And some people were saying, oh, wow, I've never heard it that way. That actually makes a lot of sense. And other people were saying, no, you guys are idiots. But especially for thinking it through the middle class. So this data from Edward Wolf I've always come back to. This is a chart I made and using his data. And if you look at like the top 1%, they break it out. He broke this out by wealth, by primary residence versus financial assets. And the top 1% has nearly 80% of their money in financial assets and like 10% in their primary residence because they have so much more money than everyone else. The next 19% of people is more like 40% in financial assets and 30% in their house. The other 80%, the whole bottom 80%, has over 60% in their primary residence and like 10% in financial assets. Their house is their nest egg for most people. And right or wrong, that's kind of the way it works out. Housing is a form of forced savings. These people don't have enough discretionary income to save, whatever the case may be, their house is it for them. And if you look at it, you think about, so the U.S. home ownership rate, so there's this chart from Y Charts on this, it's like 66%. For some reason, it had this huge spike up to 68 in the middle of the pandemic. Now it's come back a little bit, but still 66%. So a lot of people are saying that, well, that's an elitist way to think about the world, because if you're saying that people are going to benefit from inflation because they own a home, a lot of people are screwed. You know who's just really screwed here is kind of millennials. Because if 2/3 of the country already owns a house and you're in the group that is trying to now buy your first home, I mean, Gen Z, we talked about, is probably in a good position because they can rent more cheaply now in big cities if that's what they choose to do. I think millennials just got screwed. They were just in a horrible position, right? Because if you own a home right now, it's going up in value. Rates have come down so you could refinance, and you're in a pretty good position where if you locked in rates for 3% or 2.5%, whatever it is, if inflation comes in at 2%, you're effectively, after interest costs, are borrowing for nothing.
Well, first-time home buyers, yeah, it sucks. But did you know that the oldest millennial is now 65 years old?
That's me. But yeah, I just wanted to, a lot of people didn't really understand that. And it's like, yeah, anytime you borrow for a long period of time, inflation is a pretty good thing for you. Because it's the opposite of being a bondholder. If you're a bondholder, your biggest risk is not interest rate volatility, it's inflation, eating away at the money that you're being paid back in a fixed amount over time. Anyway, just wanted to kind of mention that I think overall, housing prices going up and interest rates going down and stuff is benefiting homeowners. Unfortunately, for people who are just trying to buy their first home and come up with a huge down payment, they're at a huge disadvantage right now.
Yeah, it's brutal.
Okay, I cannot imagine being a bear on the economy right now. How about this? This is from Goldman Sachs. We have raised our GDP forecast to reflect the latest fiscal policy news and now expect 8% growth in 2021 and an unemployment rate of 4% by the end of the year, the lowest among census forecasts. It falls to 3.5% in 2022, 3.2% unemployment by 2023. Goldman is calling for.
Is anybody bearish on the economy? I feel like people are bearish on the stock market. I'm not seeing, you can be bearish on the stock market and bullish on the economy. It's sort of like when people were bearish on Bitcoin but bullish on the blockchain, which turned out to be pretty terrible, pretty bad.
But don't you think we're going to get the anti-Fed, anti-government people are going to be so angry at this potentially coming, like I think we're going to have an economic boom for 2 to 3 years. People are going to be mad about it. Can you see that happening?
People are always mad.
They're going to, just like when the stock market was rising, well, if you took out the Fed, if the Fed wasn't propping up, this wouldn't happen. And they're going to say the same thing about the economy, that, oh, if it wasn't for the government. But I always go back to this one from Bill McBride, wrote 3 or 4 years ago, that 2% is the new 4% for economic growth because of demographics, population growth. And that always kind of stuck with me. But now I think politicians realize economic growth is a policy choice. And you can hate that if you want, and you can write newsletters about how it's not fair and it's all going to be fake growth and it's manipulated. But if politicians want economic growth, they can create it by spending money. Obviously, there's risks to that, but that is a thing, right? And I think politicians are realizing that. Like, can you imagine if we get 6% growth for a couple of years or something? How is that ever going to be taken off the table unless political will decides that they don't want this anymore?
What's your price tag on the Dow? Let's go. Put some meat on this.
No, I'm saying this is probably more bullish for the economy than the stock market in some ways. Where let's just say
it. That's a cop out. I'm super bullish on the stock market. I'm not afraid to say it.
Okay, I think I would be happy in the coming years with just average returns, 8 to 10%. I'm not saying like 20% a year. And it's kind of crazy. You're seeing after the financial crisis, every economist was. You remember that Robert Gordon book, which I think is still one of the better statistical books I've read in a long. I go back to
The Rise and Fall of American Growth is excellent.
I reference that one all the time for these, like how things have changed over time and how. So all these economists for so long were talking about secular stagnation and things getting worse, and we're screwed basically. So Neil Irwin at the New York Times wrote a piece about how he's finally, after like 20 years of writing about the economy, he's finally optimistic for the first time in his career. And he gave like these 17 reasons, and he talked about like battery technology, for instance. He said that the price of these lithium-ion batteries has fallen 90% since 2010. Then you have these things coming like driverless cars and remote work, and the fact that like a crisis like this spurs innovation, like vaccines, tight labor markets, like places are going to have to innovate. If you have 3% unemployment rate, you're going to have to either innovate or become more productive or more efficient. He's talking about how millennials are entering their prime earning years. Economic growth, again, it's a policy choice, and the Fed has said like we're stepping out of the way and we're going to let this thing run a little hot. And it's weird to think that that is happening. At the same time, people are calling for the stock market to just fall out of bed and completely crash and fall 60%. I just can't square that in my mind right now that you could think that. I mean, maybe you say, well, it's a bubble and bubbles always get worse, and so the bubble will go for 3 more years and then it'll crash. But it's bizarre.
You think people are afraid to like be vocally bullish? Like, I feel like we often toe the line. Like, I'm super bullish right now. Caveat, I'm not like doing anything about it differently than I ordinarily would, right? Like, I'm always invested in the same posture. I wouldn't be surprised if I'm completely wrong and I look like a moron. But I'm not afraid to say it. I'm very, very bullish on the stock market. I think that we spoke about this last week briefly, that like people are getting too cute and overthinking this. It's hard for me to see an economic boom without the stock market joining. And maybe we already got those gains in the last 5 years. I don't know. I guess that's possible, but I would be fairly surprised if that's the outcome.
I do think by nature, finance people are just, they're apt to look at the risk and the downside of things.
Sure, I get it.
Yeah. So I think that I have an optimistic bent, but I do agree. Like, we have to still look for the range of outcomes, and what if something comes out of left field that we don't know about?
In 2012, at Barry's Big Picture Conference, I remember listening to Dylan Grice. I don't remember if he was at SocGen at the time, but I was blown away by his intellect. He sounded so smart, and he scared the shit out of me. He said, I get paid to worry about the downside. The upside will take care of itself. And I thought that was like so intellectually stimulating. But for goodness sakes, if you're too worried about the downside, then you're not going to get the upside.
Yes. And I think too many people in finance have been conditioned to realize that talking more about the downside sells way better than the upside in the past 12 to 15 years. So I think people are still so scarred by the 2008 experience.
Well, because if you're bullish and wrong, then you're clearly wrong, right? Like, you have egg on your face, you were a cheerleader, you were naive to the risks. But if you're bearish, then you could just say I'm early. Like, there's no end date, right?
Right.
You could be perpetually bearish because, listen, an 80% decline, I know I've been saying it for 17 years, but just one 80% decline away from me being right.
I just saw Harry Dent last week was calling for another crash this year.
There you go.
if you can believe it.
He means it this time.
All right. So this was some good myth busting, I thought, by Morgan Housel. And you've seen this chart, this M1 money stock chart. And it just goes vertical last year. And people use that as they overlay that chart on everything. The stock market, interest rates, whatever. And I don't think anyone really that posts that chart as a scare tactic even really realizes what it is. So it's just cash. M1 is cash, right? What are you laughing at?
Sorry. I just got distracted by a Joe Weisenthal tweet. Sorry to interrupt. This is pretty great, though. People accuse me of being a fiat shill. Well, I've decided to put my money where my mouth is. In 2021, I'm electing to take my entire salary in USD.
All right.
Well, we're speaking about money supply. It's appropriate.
Speaking of. All right. So M1 is money supply. So it's like paper and cash and coins and checking accounts. And M2 includes like money markets and savings accounts. And Morgan says, yes, this thing charged higher, but the Fed also said that like they eliminated this rule on savings account that you could have a 6 withdrawal limit in a month or something. And so that shifted savings accounts from M2 to M1. So like 11 trillion of this $14 trillion increase came from moving savings accounts to checking accounts. It was basically an accounting change.
Okay, got it. So 80% came from an accounting rule. Okay, fine, fair enough. But that doesn't take away from the fact that we still printed a shit ton of money.
Yes,
which I'm fine with.
But not as much money as people thought.
Correct.
And this is, I thought, like one of the greatest charts I've seen in a while. So someone posted this on Twitter this morning, and it's government debt from 1990 to 2020. And it also shows a net interest cost. And government debt is up threefold almost in that time. And net interest cost, the amount of interest expenses you pay on that, has almost been cut in half.
USA.
So because interest rates have fallen so much, we're paying half as much as we did in 1990 on government debt for interest expense. So people always say, like, who's going to pay for it? Well, we have so much more. If rates stay this low, we have plenty of room to print more money.